Yeah, I think we can go ahead and
get started.
So, welcome everybody. I'm Steve Morris with the Oregon Technology Business Center, and we have Ernie Boetsma with us today with Aderwin, and you can't see him, but off to the side, as usual, is Jim McCrite, also with OTBC, and Jim's monitoring the chat room, and he'll make sure that we don't miss your questions to address those. So. Certainly want to go ahead and encourage people to go ahead and mark up your questions in the chat room, or enter your questions in the chat room. Also wanted to mention, and I'll try to remember at the end too, that the news at OTBC is that we are open for accepting applications to our annual Beaverton Startup Challenge. And we're open until October 1, and then we'll pick 5 companies that apply and invest $25,000 in each of them. So if that sounds interesting, and being headquartered at OTBC for a year would work for you to get some mentoring and investor help and so forth, please check that out at otbc.org. And Ernie, want to do a quick intro?
Yes, hi, I'm Ernie Boetsma. I'm a partner with Aderwin, and I've been practicing in the area of startups and corporate transactions for 29 years, and have been doing these kinds of financing for over 20.
Very good.
Well,
and we have, let's see, we have Ashlyn now also. Let's see. While people are queuing up some questions, I thought it'd be great to have Ernie maybe start just describing the overall process of doing a priced equity round, because there's a lot more, of course, than just coming up with something like the Series Seed documents to it.
Yeah, and so looking back at Steve's video, it was a great summary of the documents themselves, some of the things that are typical or not in a general Series A priced round. But again, I thought it may be helpful to step back and think about what you're trying to accomplish, and that is, this is a fundamental change to your company. So you do have to think in terms, it's a corporate change. So like in any transaction, you're going to need to have board approval for the offering. There's going to be board and shareholder approval of the amendments to the articles or the charter. And then that charter that's actually in the document package that comes from the website, that charter actually has to be probably revised for your corporation and then filed with the Secretary of State of whatever state we have involved. So that could be Oregon, it could be Delaware, it could be Washington. So again, it's going to need to be revised to get filed in that state. The other documents, the term sheet and the investor rights agreement, those are really just contracts. So in the end, you and the investors will be negotiating those and signing them as part of the closing, but there's they don't necessarily need to be filed or put anywhere other than in your corporate minute book. I mean, those are some of the basic issues. And again, because you're selling securities, one thing to keep in mind is you probably do need an attorney to do this with you. Just like with any transaction, when you're selling securities, then you have to deal with state and federal securities laws, which we have touched on in previous Q&A sessions. And really, those laws are generally the same for this type of transaction. So each investor is going to need to qualify in one of those exemptions, or the company needs to fit into an exemption as to a particular offering. So again, having advice on that issue is going to be necessary to get this transaction closed. I still think it's an abbreviated transaction, like Steve noted in the video itself, but again, it's got more pieces to it than it appears on its face.
Actually, it brings up one question about the documents. I mentioned in the video that the actual Series C documents are 50 some odd pages. Mm-hmm. I'm curious, when you do your typical equity investment, how thick is the stack of documents?
I would say your expectation, I think you mentioned in the video that they could be around 100. I think that's probably accurate. You have a couple other documents that are not in this package. So one is a right of first refusal and co-sale agreement is in the The National Venture Capital Association has a standard set of Series A documents. In that co-sale agreement is included. There's also a registration rights agreement, so there's all the registration rights in the event that you have an IPO in the future. Again, that's one of those documents I think it makes sense not to have in a seed series, because it just overcomplicates it, and most of your companies are not going to end up at IPO anyway, or if they do, you can revise them later in subsequent rounds. So
there'll be a later round at least.
There'll be plenty of time to deal with that. And maybe that's another good point to raise, that when you amend the articles or the charter for this transaction, you're going to be amending those articles each time. So every time you raise a new round, you'll thoroughly rewrite that entire charter from scratch. So again, it'll just be revised and negotiated each time there's a new set of investors. And one thing you keep in mind is the latest investors are always the ones that are going to dictate the terms. So again, and one nice thing about a seed series like this is the company does control it, and you get a little more control over that negotiation, and maybe you get better terms because you've got individuals who don't have the power to renegotiate the whole transaction.
Yep, and anything you agreed to and the other investors agreed to in a previous round is open for change if they want the new money.
Although there is a theory that once you sort of agree to something one time, later investors always build on it. So in other words, they don't end up getting worse terms later on. If you've given in to something now, it may set a precedent for later, at least in a negotiating standpoint.
Indeed. Let's see, we had a question from Russell. Typically advise clients to raise seed funds for at least to get them to minimum viable product, or for 6 months of burn time. Thoughts on best practices just in terms of what amount of runway to go for?
Yeah, 6 months seems maybe a little short for going through the process of raising a priced round. I often think of note rounds of that sort of 0 to 500,000, and a priced round like this maybe would be between 500 and you could even go as high as 2 million. Although I think that's probably pushing the limits of a seed series, but it's possible. I mean, a nice thing about these is there are no rules of thumb. There's no cap on it. You could, in fact, sell as much as you can raise. The only issue with a priced round is because you're setting the price. The more you sell, you're going to be giving away more. You're having more dilution, and again, there's going to be an expectation there'll be an increased price in the next round. And again, hopefully, you've set that price at an adequate valuation.
And there's always the trade-off of course, on the one hand, you'd like to get the minimum amount of money that you need to accomplish your milestone for minimum dilution. On the other hand, everything always takes longer than you think it should. And so it's important to have some buffer. So yeah, planning, I totally agree with Ernie. Planning on a 6 month horizon is, that's not a lot of time to get a lot done. So I would tend to hedge a little more on the little more runway side, even for an early round.
Yeah, and maybe Russell's point is accurate in the sense that I would really focus on what is the amount of money that you need to get to some milestone that truly would make the valuation jump, because that's going to be the key issue. You're not going to do a Series A, you're not going to raise it from a venture firm until you've got a valuation that you can support. Well, the way to do that is to have achieved certain milestones. So if your budgeting and your planning shows that you need an MVP, but maybe it shows that you need to land those first few customers, you need to plan that's the amount of money you need to raise now in this seed series in order to achieve those milestones. And like Steve said, everything normally takes longer. I use the rule of thumb of twice or three times. So if you think it's 500,000, it might be $1 million or $1.5 million, and really plan on raising that amount now.
And that is a common problem you see with inexperienced entrepreneurs, is they'll say, well, I need 500,000 to hire salespeople and do this and do that. Well, okay, but what does that get you to? Does that get you to a fundable milestone so you've made enough headway that you're worth more and you can raise that larger round for the next step? So that, planning out a funding strategy is tricky. You have to think 2 or 3 steps ahead. It's not just oh, I need money to hire salespeople right now. What will that get you to that's fundable?
And actually, I think that raises the point of you may want to socialize some of that decision making. So in other words, when you're talking to investors, talk to them about what are the milestones that are going to provide value to you as an investor, and they're going to give you that feedback so that you'll start to know these are the milestones we need to reach. Not just hiring a particular person or building out the team, but maybe the investor is saying back to you, you need to land X number of customers or something like that. So you're really planning towards that event that you're getting feedback on.
Yeah, it's a great thing to do, essentially a trial close on, right, is to ask, well, here's our thinking. We think if we do this, that'll get us ready for our next round. What do you think? And get some investor feedback and perspective on it.
That actually raises one more point, and I see we have a couple questions coming up, but I'll answer this or describe this a little bit. One nice thing about this document package is it does give you this term sheet, and so you can work with your attorney to maybe fill in some of the blanks. And a lot of times what you can do is take that term sheet and then socialize that around with as many people as possible before you do any of that other work that we described, and really start getting that feedback first. Is the valuation correct? Are the terms sufficient for you investors that we have in mind? Would you be willing to join in this investment if we do it? It's a way of getting that feedback in advance.
Yep. Let's see. So Don's question, how do you think that investors can get comfortable with the absence of price-based anti-dilution rights with the Series Seed? In a down round, early Series Seed investors get a bad rap. Yes, they do. Actually, I have a thought, but Ernie?
My reaction is, if I were the investors, I would ask for a protective provision that allows for that veto right that Steve mentions in the video. It is something that's you are giving away to these seed series investors, but if they had a veto right to new issuances altogether, or at least issuances that are at a price different than their own, then you kind of get to the same place. In other words, you don't have to go through anti-dilution protection. It requires a lot of pages to the document. It's a complicated formulaic methodology, and by removing that, you can simplify that decision tree by having that protective provision, I think.
But yeah, that gives you a lot of leverage to branch out into other areas. But I guess the flip side of that though is if things aren't going well and the company is running out of money and they're going to have to do a down round, then sometimes you got to do what you got to do, and I think that can get into a situation where again the new money has a lot of leverage. So the new money is may really drive a hard deal, and frankly, if you got to have the money to survive, then the existing investors may simply have to swallow hard. Again, when things aren't going well, nobody's happy.
Yeah. Again, I think that's why, at least from my perspective, if I were the investor, I would like the protective provision, because at least then the company has to come to me or me as a group of investors and ask our permission to do that later round. And again, hopefully we're smart enough to realize that the company needs this new money, and we have to be willing to accept it on its tougher terms.
Let's see. Here's a question from Matthew about the venture capital operating company related to ERISA, and I in the video I certainly only knew enough of that to be dangerous. This idea that you need the management rights letter, especially if you're a pension fund, to avoid some egregious reporting requirements, and that was part of the rationale, the need for a management rights letter. But Ernie, any other comments
actually,
on
I'm
that?
going to have to admit I am a lawyer that does not fall into the ERISA category, so it is not something that I feel really comfortable speaking about. And I apologize. One thing about the law is it is a very specialized, just like any other professional service these days. And again, I do more of the financing, corporate finance side, and not necessarily the ERISA side.
And it is kind of a specialized thing. This is probably not relevant to an angel round that might be more of a serious round. This would be more relevant to a venture fund that has pension funds investing in it, right? If it doesn't have pension funds, then I don't think ERISA really applies. But
and I guess the way I would approach it as an entrepreneur is that maybe it's an issue spotting matter. So in other words, both you and your lawyer should at least know that one of your potential investors is a fund that has pension funds, and so because of this, they're going to be doing additional reporting, which they actually require from you. I do have a client that has an investment fund that is a VOCC. Again, I'm not required, nor is the entrepreneur required to know a lot about those rules. They just tell us the additional information that they need in order to do their reporting. And so, as Steve said, you generally will have this management letter with that fund where you agree to essentially provide them with the quarterly and annual reports that they need to do that reporting. So again, hopefully that answers your question.
Let's see, and so Don, follow on to the earlier question, how about just adding a broad-based anti-dilution clause to the Series C document before investors are willing to invest? And yeah, that does expand the documents. The whole idea behind the Series C is it has the clause in there saying thou shalt not add to it. But obviously, you can add to it.
Yes, it's like everything, it's negotiable. And a price-based weighted average anti-dilution protection is a pretty normal matter in a Series A transaction. So again, it would be fairly easy probably to grab those provisions from a typical Series A transaction and put it into this charter and articles. It will lengthen it probably 4, 5, 6 pages, and you would have to add it to your term sheet. But basically the concept is there's a weighted average formula. So for example, if you had a 50-cent price in this transaction and you later issue shares for 49 cents, it will take into account that 1 penny difference, but it'll also weigh how many shares that you issued at the lower price versus how many shares did the seed series investors receive. And you'll adjust actually what they call the conversion ratio. In fact, I'm going through this right now on a down round, and it's an interesting exercise. It does complicate things more, and so again, if your goal is simplicity, and again, even like the term on the attorney fees, if you're going to raise the complexity a little bit, they may negotiate higher numbers there, so it's going to cost you more. So just keep that in mind.
But the whole anti-dilution thing is certainly is a good thing for an entrepreneur to understand, because it does get you into some complexity. And again, as I talked about at a really high level in the video, is that it has to do with that situation where you sold stock to one investor group and then you sell stock to somebody else at a lower price, which again causes unhappiness on the part of your investors, because you should have made more headway, you should be worth more, not less, and so that generally calls out for some adjustment. So it's a very, very commonly you'll see some kind of anti-dilution clause in a round. And that the question I had for you, Ernie, was when you think again in general about a priced round as opposed to a convertible security, what are the terms in it that you would suggest to an entrepreneur are like the really important things to pay attention to, as opposed to some other things?
It's typically going to be valuation is always number one. So in other words, any investor, that's going to be their primary or their first goal, is they're going to look at valuation and how that relates to the cap table. So they may have requirements around, and I think Steve, you really go into this in the video a little bit, around like how many shares are going to be in your option plan. So they're going to shift that dilution prior to the transaction so that you're taking that dilution for the plan. So again, valuation is going to be the number one issue. If I'm an investor, the other issues are also around maybe voting rights, and in particular those protective provisions. So the seed series has some protective provisions in it. Sometimes they get more expansive in that area in particular. So again, that's this protective provisions are the situation where these preferred investors get to vote separately as a separate class, not co-voting along with the common. So they actually have a veto right, is what we call, or essentially the right to approve in a particular issue by themselves. So those protective provisions become heavily negotiated. The board seat becomes heavily negotiated because, again, that goes right to the heart of the matter. Control, valuation, and control are the two key issues. And then the rest of the things regarding maybe information rights or other similar matters like anti-dilution are usually less. They're farther down the level of items that are negotiated.
So, where would you put liquidation preferences in that
actually,
list?
liquidation, that's good. I missed that one.
That might be fairly high.
Yeah, that's fairly high. That's right up there with valuation. And so liquidation preference, so this particular, the seed series basically says it's a 1x return. Is it a participating? I can't recall.
I don't think it's participating the way I read it. I think the docs just say you have the option to either do 1x or you convert.
Yeah, so a 1x liquidation preference basically means that the investors get, it's what we call downside protection. It's really set up that if there's a liquidation of the company for something around, or close to being equal to the original investment of these seed series investors, they get their money back first and the common will get whatever's left. If the value that's being distributed in a liquidation is, say, twice the amount the investors put in, then again there might be a reason for those investors to convert to common before the liquidation and then just share on a pro rata basis. And there is a tipping point there, that every time there's a liquidation event, the investors have to go through this analysis to determine whether it makes more sense to take their liquidation of 1x and stop participating, or participate on a co-equal or pro rata basis with the common. And so that is an important aspect. And so again, what does that downside protection look like? So investors sometimes will argue for a 2x or a 3x, or they'll want a 1x, and then after that they automatically participate pro rata with a common. That's called a participating liquidation for those investors. So again, that's heavily, that too would be heavily negotiated.
And whatever it is they get up front as an option, whether 1x or more, again, that money goes off the table before the founders get anything. So if it's an acquisition, but it's not a really rich one, that can be important to the entrepreneur.
And money solves all these things. So if you exit for 10 times or 100 times your, the original investment valuation, everyone's going to be happy because they're all going to share.
Yep. So it's much nicer when it's a really good exit, and then everybody converts and everybody's happy. Let's see. Russell had a question. Let's see. Well, Don had a question first. Should an investor be comforted with less company representations in a Series Seed versus typical A preferred? Slightly longer document, not a big deal for investors. I guess the question is for a really early Series Seed, in terms of representations, it's an early company, right? There's just not as much there to represent.
Yeah, I guess the investor wouldn't necessarily be comforted by that. I think, so to answer your question, Don, this structure is really set up, I think, to be company favorable in the sense that it's supposed to be simple and easy. You can pull these documents down and you can hopefully go sell these to people who know there's a big risk. And hopefully the valuation is low enough that they're receiving enough of the company that they feel like it's a good exchange. And maybe they're getting less of the protections that a later Series A would require. For example, I haven't looked at specifically at these reps and warranties, but the representations and warranties in a typical Series A might cover all manner of things, from their real estate to their employees to the intellectual property to all of these various aspects of the company. In these documents, I believe they're pared down to sort of the basic corporate representations.
Yeah,
so,
I think so.
So the investors aren't receiving all that much, but they're also investing in a company that, like you were saying, doesn't yet have a lot of these bells and whistles added to it. So the reps are skinny and simple.
Yep.
Let's see.
How often do you see angel investors, if any, bought out any seed round? Any advantages for buying out angels? And I certainly haven't seen that much, but you've seen more deals.
I've seen a few, but generally later investors do not like their money going to pay off prior investors. So in other words,
they want it to go toward new milestones.
They take the position that either note holders or seed series prior investors, and I'm an A investor, I want those folks to stay on board and their risk to continue along with mine. So I rarely see a buyout. Now I've seen a couple where the prior either debt or security was so favorable to the earlier investor that the later investor wanted to take them off the table, and they were willing to do that. But I think that's a rare occasion, and I wouldn't expect it. So again, I think you have to assume if you've got a prior investor there around.
And I think that relates to Rita's question then too. Is it typical for a company to use a Series Seed vehicle versus a Series A to convert note holders? And I think the answer is no. It wouldn't be typical for either a Series Seed or a Series A.
Although it can be used, so it's a perfectly fine vehicle. What most convertible notes will have is a threshold number.
Yeah, I guess let me rephrase that. A Series Seed may or may not be big enough, right?
That's exactly right. That was the point I was just going to make.
Yeah.
So, for example, a note might require $1 million qualified financing in order to trigger conversion of all those notes. Well, in a seed series, because it's in some ways an angel investment, often an angel type investment, because you're filling out the seed series maybe with a bunch of well-heeled angels to buy the price stock. Whether you're raising $1 million is a question. It'd be nice if you can. I've actually had a couple clients that have done seed series, and we've raised $1 million to $2 million, and we converted all of the notes. So it can be done and work just fine.
And actually the same way with a safe, because a safe can have like no minimum. Mm-hmm. So really any equity investment, Series Seed, Series A, whatever, would convert that type of a convertible security.
And I think there are many note investors who want to convert to stock at some point, as long as the valuation is reasonable. So again, back to the valuation, that being the number one negotiated point. And if your note holders like the valuation, they're going to want to convert.
So yeah, either Series Seed or a Series A, as long as it hits the conversion trigger, mm-hmm. It'll do the job. Just want to encourage everybody, get those questions added to the chat room here. Take advantage of Ernie.
I'm here.
And Ernie's got a lot of experience with a lot of deals, so he's real familiar with, especially the Portland market. And is it fair? It's fair to share the news. Speaking of the Portland market, I think about Aderwin.
Yes, so I would just say people may have heard yesterday. It was in the Business Journal and the Oregonian, but Aderwin is actually joining up and merging with a firm by the name of Buckhalter, and we're going to have 9 offices all over the West Coast, and we'll be the Portland office. From Arizona to Seattle, which the benefit for me personally in working in this area is I actually have now partners who work daily in San Francisco, LA, and Seattle, and we can get to those markets for networking, for reaching out to investors and the like. So those are things that I'm looking forward to.
Let's see, a typical range of legal fees to complete a seed series, or just in general a seed investment round.
So these form documents had a $10,000 price tag for that's for the investors' counsel. Generally, the company counsel takes the laboring oar for doing any sort of additional drafting or managing collection of signatures and closing. I would probably say you're going to at least need the same amount for your company counsel, but it could be as much as an order of 1.5 times that. So that's a good way. So that would be 20 to 25,000 would be a typical amount. So again, you also have to think about then how much are we raising? You're using those funds to pay for the round. So you can't you don't want to do a seed series for $100,000 investment. It just doesn't make sense.
Convertible note or a safe sounds a lot
That's
better.
right. Yeah. I mean, it's exactly the reason why we have those other instruments. Because of this instrument, as I started out at the very beginning of this, you have a few more pieces to deal with. You really have these board consents, the amending the company, and the like. So there really is a lot more management of that process.
And as Ernie pointed out earlier, because of all those steps you have to go through, even if you don't modify, use Series C documents and you don't modify them at all, so you don't spend any legal fees on that, there are still other things in the process that probably will involve some legal fees.
Yeah, just as an example, if you have 10 investors that come into your seed series, again, back to the securities laws, we generally want them, then they're not funds, so they should probably be filling out investor questionnaires. We should then make sure what state are they located in, determine if there are blue sky laws for that state. Federal exemptions, we're going to file Form Ds in both the state and federally. Again, there's a lot of tasks that go along with the process. Let's see. Don notes that, Angel Resource Institute, Halo report, 62% of the Northwest regional angel deals in 2018 were preferred stock, 12% convertible notes, and 26% common, safe or debt or other. Kind of lumping together all of those different categories. Thoughts? That probably goes against what what I see. I see more note and safe rounds by far. That's not to say we don't have seed series, and it might be how they're defining an angel round, and it may be that small angel funds, which I would see a seed series be driven by some of these smaller angel funds. Not to pick on Portland's seed fund, but it's not necessarily an angel fund, but it's a seed fund, so it actually makes more sense, and it may fall into that definition. I'm not certain.
Portland Seed Fund, Elevate. There are some smaller funds that do smaller investments out there, and I think those generally are convertible note. I think
generally even those are convertible notes, but I've seen them come into seed series rounds as well.
Yeah.
What it really takes to have a seed series is someone willing to put in enough money to be the leader of the group.
Yeah, which is a real difference when you have a priced round. Generally there's a lead, somebody who you accept their term sheet, and then the goal is to get everybody else on the same term sheet. Whereas with convertible securities, you can have a bunch of them with a lot of different terms. So it is a little bit of a different ball game. Let's see, Russell, any gotchas, deal terms in a seed series to avoid that would hinder?
Yeah, I guess I would say I don't think anything in the base documents would hinder a later transaction other than the big variable, and we've talked about it, you can't talk about it enough, is valuation. I mean, one of the reasons that you delay valuation for notes, or when you do notes and safes, is that you want a qualified outside fund to be setting the valuation. Anytime you have maybe individual angel investors or the company setting that valuation, you have a potential for the valuation being too high or too low, and that has a potential negative impact on the company. Either you set it too low, you give away too much of the company, or you set it too high, and then your later investor doesn't believe you've achieved enough to have an increase in price, and you end up with a down round. Now we're talking about anti-dilution issues that we talked about before. Now, without anti-dilution protection in here, maybe that's solved, because the later round just would come in at a lower valuation, and the earlier investors just paid too much.
Yeah, and frankly, even with the anti-dilution language, that may happen anyway, because if you need the money, you don't have a lot of negotiation leverage.
That's right.
So, yeah, life gets tough when things aren't going well. Any way you cut it. Let's see. Any other questions out there? Let me take a look at my question list here. I think just one thing Ernie and I were talking about before we went live here was we just haven't seen a lot of specifically the Series C documents in use in the Portland market. Apparently they get used a little bit in Idaho and elsewhere. I'm not sure that there's a lot of investor awareness of them in the Portland market. So that could be another issue if you're looking at doing a Series Seed, because for whatever reason you want to do a priced round and you're trying to keep the legal cost down. good thing to talk to the investors about. I mean, if it may be the case that people are simply more comfortable with doing convertible notes or safes even than a Series Seed, and frankly, raising a round of funding is hard enough. You don't need to make it harder by trying to use a mechanism that investors aren't comfortable with. So it's another good thing to at least consider.
And part of those counsel fees that you're agreeing to pay to, that may just go to understanding having their lawyer just understand the documents. So, and again, if I don't see a lot of these, and I don't believe there are a lot of other lawyers that have seen them either. So it'll be a lot of first reads through these documents.
Yeah, and since people are used to negotiating terms, negotiating the legal wording, that could be a hard habit to get out of.
Well, and then you lose some of the benefits. I mean, some of the
Yep.
benefits of a
Yep.
of a set of documents that's formatted is, you get the lower cost of just taking them off the shelf and using them. And again, if you've got the unfamiliar lawyers who are then reviewing for the first time, then you end up negotiating more.
Let's see, another question from Rita. Is it appropriate to tell your potential investors that you're looking for a lead using these Series Seed documents?
Again, that's how I would approach it. I think, again, I like the idea of work with your own counsel to fill out the term sheet, get it where in a place that you're comfortable, and then I like the soft circling of potential investors by providing them the term sheet, because usually in a typical Series A, the investors give you the term sheet, but in this context, you're giving them the term sheet, and I think you would be clear and honest with them. We're looking for a lead, someone who will be kind of take charge of this and then run the deal for everyone else.
And Jim added a question to the list. Thoughts about the number of investors in the seed round and the size of a minimum investment?
Well, that's always a good question. And again, it sort of falls into you take what you can get. But let's just say we're trying to run this to $1 million. Well, if you took all $25,000 investments to get to $1 million, it's a whole lot of investors. And again, one thing about company capitalization generally is the more people on your cap table, the more people you've got to manage, you've got to reach out to for notices, you've got to make them feel comfortable that they're getting all the information they deserve. So as that number grows, it becomes a little difficult. If I was going to raise $1 million, I would want $100,000 and above, so 10 would be my max. And again, it'd be nice if a couple of those were 250s or 500s. So that you could fill it out with less than 10.
Yeah, that really is a hidden cost of, especially of a priced round, although it can be an issue with convertible notes too, is that people in general who give you money, investment money, tend to need some care and attention, and that's management time, and typically early stage they'll want a lot of that time to come from the CEO. So it is yet another time commitment for the CEO. Once you get somebody's money, you have to pay a little attention to it.
And let's say you had 10 notes and you roll those 10 notes and you raise 10 more people in this round and you've got 1.5 million total, 500,000 in notes and $1 million in your seed series. That's a big number of people, and they all need that attention occasionally.
Yep. So a good thing to pay attention to. So Ernie, when you see these priced rounds being negotiated, what are the most common problems or issues, bones of contention you see coming up between the entrepreneur on the one hand and the investors?
Well, often probably the biggest friction point, I think, and I touched on it before, and that is the board seats. And it usually stems from investors believing that they are entitled to a board seat even at a lower investment. So back to the examples we were just talking about. Let's just say someone put $100,000 into your seed series. That one person isn't entitled to a board seat. Sometimes I get that sort of pushback. Now, if you say as a group, this is $1.5 million, fine, that's certainly a board seat, and I have no problem providing that seed series representation on the board of directors. what I might recommend if the seed series ends up being small, let's just say it's 500,000 total, that maybe what you offer is board visitation rights. So essentially the person has the right to notice of the meetings, attend the meetings, and get all the materials that the board members get, but not necessarily vote. And so that friction is one of the biggest ones.
It might be worth a couple of comments on why having multiple a larger number of investors on your board early on is sort of an issue.
Yeah, so boards are, typically should be an odd number of people. Oftentimes the founders want to have their representation. So typically what happens in an early investment is it's either 3 or 5 person board. And so if it's a 3-person board, it might be the common and maybe the CEO, and then the investors have a board member. If you go to 5, there might be a couple common, the CEO, the seed series, but then maybe an outside director. And again, even though these shareholders are not going to have control of the company, if they have the right to get a majority of the board of directors, management can change direction quickly. And so you want to keep in mind how you're managing the control, both from a share perspective and from a board perspective.
One of the responsibilities of the board tends to be to hire and fire the CEO, so it is something you care about.
And that's actually, it's a funny little quirk, and I've seen this in other people. Not everyone has seen it, but sometimes they'll say, well, the board, one member will be the CEO, but it is the board that fires the CEO. So if the board fires the CEO and puts in a person that they control, then they may control the board. So you do have to think about those things, and I usually will talk through that with clients as well.
Interesting question from Russell. What would be the driving factors for using a seed round, some kind of a priced equity round, versus a convertible note?
Yeah, I think a couple of them. One would be size. I think, again, people start to get uncomfortable when there are notes accruing interest in particular. When you start having $1 million, for example, in notes, it gets a little unwieldy. I have a client that has 1.2 million in notes, and that's, and then we're talking 10,000 a month in interest that's accruing. So that's all on their books as is accruing interest. So they're taking a bigger and bigger percentage of the company. So one reason would be to do a priced round, convert all those people, or not have that in the first place. That's one of the primary reasons. I seem to recall you mentioned another one in your video, and I'm having a brain freeze right now.
It's a little less compelling, but this idea that at least you know what the dilution is, right?
Yes.
I mean, if you're doing a priced round, you know what you got. Now, of course, it might surprise you that, there were all those convertible notes we also had that converted, and gosh, I thought I was doing $1 million round, and I got reminded, no, it's a $1.5 million round.
That's right.
Because all those notes convert too, so you do have to watch out for that. But at least in the priced round, that's a plus for both the investors and the entrepreneurs, is you know what the numbers are.
Yes, and there's again no more interest accruing. All these people have direct voting rights. They're part of the company. They may have representation. So from the investor standpoint, there are some benefits.
On the other hand, from the entrepreneur's point of view, a nice thing about that convertible note or a SAFE, either way, is it delays that valuation, and that's certainly a plus. On the side of the entrepreneur. Now, again, the note or SAFE is probably going to get a discount, so you only end up winning from a dilution point of view if your value increase exceeds what the discount was. But still, that's another benefit on the side of the note.
So Don raised the issue of the 2018 Halo report indicates that the the pre-money valuation for seed rounds in the Northwest was approximately $6 million, and the median was $5 million. What is your experience? And I actually would say that's probably pretty close to what my experience is. Maybe a little slightly less than that.
So in defining seed rounds, I assume they would be specifically talking about priced rounds then, right?
Yes.
Not convertible notes, because that doesn't really have a pre-money value. So you're looking at something that was by definition big enough to justify a priced round, i.e. with the additional legal expense and so forth. So I mean it would make sense that these are not $2 or $3 million pre-money deals. They're a little farther along.
Yeah, so if we had a $6 million pre-money valuation and we raised $2 million in the seed series, you'd be selling a quarter of the company. So that's about right in the size of the transaction, how much you would raise, and that 2 million would, let's just say it included the conversion of your notes. So again, that feels like about the right size. You might raise $1.5 million of new money and have notes converted, and that would be the right valuation. If you're much higher than that, I would say you're starting to move into a Series A type valuation. And again, then the expectation is that the seed should be jumping even higher to an A. And if you start at an A price, then you've overvalued. So you do want to be careful about those valuations.
So speaking of valuations, which is obviously always a hot topic, and I think it's fair to say that it is at least as much art as science.
Yes.
But what I'm curious, what kind, you see a lot of deals, what kind of rationales do you see from investors for for the valuation that they're comfortable with?
Yeah, that's a good question. A lot of times they don't share that information. So truly, if it's a fund, most of them do their own sort of analysis of valuations of the company based upon where the company is, what it expects to raise in upcoming rounds, what ownership percentage the fund will receive, and they sort of project it all out and work backwards again, and to make sure that this really works for them. I don't often see into that. I think if we have any people who are with the Oregon Angel Fund, they might have a better insight in how they do that on a regular basis.
That would be an interesting topic all by itself.
It would be.
Let's see. Rita had a question. What type of investor can lead / price a Series seed round?
Well, it really could be anyone. Again, I would probably prefer that it be a small fund, or if it's not a small fund, at least a very well-heeled angel who's sophisticated enough in making angel investments in other companies
and well-connected. Because that's the other thing you're looking for in a lead.
That's right.
They're on sort of on your side of the table once they become lead, and the job is to finish out the round.
Yes, help you go out and connect with all those folks to find the additional closings that you can. Because these can be structured so maybe there's a couple investors who close it. You take in the first 250, and then you go out and just keep raising for a couple months. This can be structured that way. But again, those people that are lead would be the people that you want to then make those introductions. They're already invested not only in money, you want them invested in their time and energy as well.
And Don noted that the Northwest Halo report appears to be primarily from Alliance of Angels, Karatsu, and Sea Change funds, so and Golden Seed. So maybe a little bit narrow of a group and each of those funds have angel funds. All right. I think let's see. I think at least we have audio back now. It'll take a few seconds for them to hear that, but you might let us know if you're hearing audio. Yeah.
Okay.
Yeah. Okay. Sorry about that. I think we have a problem with with the camera, but we just kicked in a different microphone. So rather than muck around with the technology, as long as we have audio, let's see if we can tackle one or two more questions. Alora said, would you speak more about the Portland market? You mentioned they are not using Series Seed as much. What types of investors do you see the most of in the areas, and or do they tend to be local? Or what do maybe investment rounds that we see here tend to be primarily local investors or investors from outside the area? I think is perhaps.
Yeah, I think most investors here are, most price rounds like this are going to be angel investors. They are local, and angel investing is such that it's generally the reason why it's more local is because those folks have a direct contact with the company. They want to be involved. They want to have some say in the company. Maybe they bring something to the table. So generally, yes, they would be, angel investors that are closer to the company's location. Let's see. I'm just reading the question again. We don't see. I think what Steve meant about we don't see seed series. We don't see
the specific seed series documents,
Fenwick documents that are formatted, pre-formatted. That's not to say we don't do seed series rounds. In fact, I've done many of them over the years. And generally, what we do as a company then is I'll take a typical Series A transaction and just start cutting things out, which is essentially I think what they've done here with these formatted documents is we'll do the same process. And I have kind of a seed series term sheet and a set of documents that I use, although I'm not opposed to using this formatted set in the future. Again, if people come to me and say that's what they'd like to use.
So do we have any more questions out there we can tackle?
I'm just asking Laura if she'd like to plug the West Side Pub Talk about it and investors.
Worth a mention?
Yes, so we have our next month's West Side Pub Talk. The OEN Pub Talk will be at the Golden Valley Brewery. I think that is
on the 18th?
18th,
I believe.
Yes, and it's called Where Do Angels Hide? And the panel actually will be a set of angels, and the primary goal will be to talk about where are those angel investors located and where can you find them. And again, a lot of it is networking, and it's nice to have a few of them give you that information about where you might reach out to a few. And so come to the OEN West Side Pub Talk on the 18th.
Yeah, and I did mention.
Here we are. Oh. Hey, we're back.
We're sort of back there. A quick repair job. I'm better crank down that audio, so we're back here. All right, we're sort of back, but. Yeah, I had mentioned also right at the beginning, we are accepting applications now at OTBC also for the Beaverton Startup Challenge. That's a $25,000 convertible note investment, not a Series Seed, but we'll invest in 5 companies, make that decision actually by mid-November, but applications are open right now, so I'd encourage you to take a look at that.
We did have one more question from Chris about the size of angel investments, and yes, I think that's accurate. So Chris points out that typical angel investments in Portland area are 25 to 50,000, and that's often what I see as well. Partly because I think angel investors, what they're doing is they're trying to put their money into a range of companies. The general wisdom is they want to build a portfolio just like a fund does. So they're going to do $25,000 to $50,000 investments in 5 to 10 companies. So they're spreading their money around. So that is accurate. Now there are some investors who have much deeper pockets. They're harder to find. And they often will be more selective, and those are the people you really want to find for a seed series, again, like we were talking about.
And that just takes networking.
And sometimes that fundraising is one of the things it's a founder, it just takes a lot of your time. It might even be half your time or more when you're really full on in fundraising mode.
Let's see, I think different from what the Halo report. Yeah, again, keep in mind the Halo report is sort of might be a little bit of a biased sample, but I think maybe we're running out of questions, and it is getting really close to 1:00. Unless anybody has a last question or two, we can try to tackle.
Well, and I want to say a shout out to we have a person watching from England, so that's our farthest away that we've seen.
Indeed.
CG man, welcome.
Indeed. That by far is the farthest.
All right, if we don't have any more questions, I think we can call that a day for now. And if you can always email us if you do have follow-on questions that you think of, and let us know.
Absolutely. Thanks everybody for joining us. And who knows, this went well enough that maybe we'll have to find more topics to tackle this way.
Absolutely.
All right. Thanks all.